What happened last Thursday is something that absolutely no one in the mainstream media is talking about, and it is the kind of quiet event that should make your hair stand on end. While every single headline was screaming about the $7 trillion in global stock market value that evaporated in a matter of days, and while analysts were busy debating on cable news whether this was just a healthy correction or the start of a bear market, a specific and devastating event unfolded in the shadows. Metropolitan Capital Bank and Trust in Chicago closed its doors permanently. Just like that, $261 million in assets were essentially wiped from the private ledger and seized by federal regulators on Thursday, January 30th, 2026. This is officially the first bank failure of the year, and as I record this on Sunday, February 1st, the silence surrounding it is deafening. But here is what makes this truly terrifying. It isn't the failure of Metropolitan Capital itself. Banks fail periodically. That is a part of the risk of a fractional reserve system. What is terrifying is what is happening right now, at this very moment, that regulators and Treasury officials are not telling you. Behind the scenes, deposit withdrawals across regional banks have accelerated by a staggering 43% in just the last 72 hours. This isn't a 1930s-style panic with people wearing overcoats and standing in lines around the block. This is a silent, digital, and invisible bank run. It is a run in slow motion conducted through smartphone apps and wire transfers while the world sleeps. We are currently witnessing stage 3 of a systemic pattern that has destroyed banking systems 17 times in modern history. Every single time, it starts exactly like this. A market shock occurs, followed by a small bank failure that the media paints as an isolated incident. Then we enter the silent phase. This is the phase where the smart money moves first. It's the phase where deposits hemorrhage from weak institutions to perceived safety. And it is the phase that always, without exception, ends with systemic collapse. We are in that phase right now. The Chicago Bank wasn't a random casualty. It was the signal. It was the confirmation that the market volatility we saw last week wasn't a one-time event, but the trigger for a banking crisis unfolding in real time. To understand why your money might be at risk, you have to understand the 4-stage pattern of a banking collapse. Stage 1 is genuine stability. This is when banks are actually well capitalized and deposits are sticky, meaning people have no reason to move them. The system works because it is built on real solvency and deep-seated trust. Everyone believes the system is rock solid because for a time it actually is. Then we move into stage 2, expansion. This is the danger zone. This is when banks start competing aggressively for your deposits by offering higher yields, which forces them to take on riskier loans to pay for that yield. They begin to stretch duration, which is a fancy way of saying they take your short-term deposits and lock them up in long-term illiquid loans like commercial real estate. On the surface, everything looks incredible. Profits are up, bank stocks are hitting all-time highs, and regulators see growth and assume it equals health. But nobody rings a bell at the peak to tell you that the expansion has become an overextension. That leads us to where we are today. Stage 3, the awakening. This is when something finally breaks. It doesn't break everywhere at once. It breaks in a corner of the market like Metropolitan Capital in Chicago. A market shock, like a $7 trillion crash, exposes the underlying fragility that was hidden during the expansion. Depositors start questioning the safety of their funds. They don't do it loudly. They do it quietly by moving money from regional banks to too-big-to-fail institutions or into Treasury bills. This movement is perfectly rational for the individual, but for the system, it is devastating. Fractional reserve banking only works if most people leave their money exactly where it is. When even a small percentage moves at once, even a healthy bank can face a liquidity crisis. Finally, we hit stage 4, the collapse. This is when the bank run becomes visible to everyone. This is when you see the emergency measures, the forced mergers, and the bailouts. But by the time you see stage 4 on the news, it is already too late for the average depositor. Access to funds gets frozen, and even with FDIC insurance, the disruption to your life and business can be permanent. The banks that fail aren't always the worst managed. They are simply the ones whose depositors moved first. If you think this is an exaggeration, look at the Great Depression between 1930 and 1933. Most people think the banking crisis started the day the stock market crashed in 1929, but it didn't. Banks actually seemed fine for months after Black Tuesday. They thought they had weathered the storm. They were wrong. The first major collapse didn't happen until December 1930, when the Bank of United States in New York failed. It was the largest failure in history at the time, affecting 400,000 depositors. The media called it isolated. They said it was due to poor management and real estate exposure, exactly what they are saying today about the Chicago Bank. That isolated incident triggered a silent run across the country. By 1931, over 2,000 banks had failed. These weren't just bad banks. Many were solvent but lacked liquidity. When 20% of people wanted their cash and the bank only held 10%, the math simply broke. By 1933, 9,000 banks, one-third of the entire American system, were gone. It forced President Roosevelt to declare a national bank holiday, freezing every account in the country. Over 5,000 of those banks never reopened their doors. People who didn't see the pattern, who trusted the isolated incident narrative, lost everything. We saw this again during the savings and loan crisis of the late 80s. It followed the same path. Deregulation and expansion into risky real estate led to a few small failures in Texas and the Southwest. Everyone said it was a local problem, but it wasn't. It became a $250 billion taxpayer bailout in today's money because the silent movement of deposits eventually became a systemic flood. And if you think this is ancient history, just look back to 2023. Silicon Valley Bank, Signature Bank, and First Republic, three of the four largest failures in U.S. history, all happened within 90 days. They followed the pattern perfectly. Stage 1 was the post-2008 era of low rates. Stage 2 was the expansion where banks loaded up on long-duration government bonds that paid almost nothing. When the Fed hiked rates in 2022 at the fastest pace in 40 years, the value of those bonds cratered. Silicon Valley Bank had $15 billion in unrealized losses. On March 8th, they tried to raise capital to look proactive, but it backfired. Because of smartphone apps, they lost $42 billion in deposits, 25% of their entire base in a single day. It wasn't a line at the door. It was a digital execution. The 2023 crisis didn't end because the problems were solved. It paused because the government broke the rules and guaranteed everyone's deposits, even those above the FDIC limit. They kicked the can down the road, and that road just ended last week. Between January 26th and January 30th, 2026, the market shock returned. $7 trillion in value vanished. Regional bank stocks got hammered disproportionately because sophisticated investors know that market volatility exposes banking fragility. The Metropolitan capital failure is the 2026 version of the Bank of United States. It is the signal that Stage 3 has begun. The current system is arguably more vulnerable today than it was in 2023. Commercial real estate values are still in a freefall. Office buildings are sitting empty, and regional banks hold 70% of those loans. On top of that, banks are still sitting on hundreds of billions in unrealized losses from bonds bought when rates were at zero. These losses are unrealized only as long as people don't pull their money, but depositors can now move millions in seconds. The speed of a bank run has accelerated exponentially while the plumbing of the system has stayed the same. So, what happens next? The sequence is mathematically certain. In the short term, the next few days and weeks, you need to watch regional bank stocks. If they continue to drop faster than the S&P 500, it is a direct signal that deposit flight is accelerating. You should also watch for sudden merger announcements. This is often a way for regulators to hide a failure by forcing a healthy bank to swallow a dying one before the public notices. In the medium term, watch the quarterly earnings reports. If they show a massive drop in uninsured deposits, that is your confirmation that we are deep in Stage 3. We are currently heading towards Stage 4, visible runs and potential systemic intervention. But this time is different. In 2023, the government had the political will to step in. Today, the national debt is at $38 trillion, and the public's appetite for another billionaire bailout is non-existent. The safety net might not hold. I hear the objections already. People say, I have FDIC insurance, I'm safe. While the insurance is genuine, you have to understand that when a bank fails, you lose access to your money immediately. It can take days or weeks for the FDIC to process claims, especially if multiple banks fail at once. If you have bills to pay or a business to run, that delay is a crisis in itself. And if you have over $250,000 in one institution, you are an unsecured creditor. You might wait years to get pennies on the dollar. Others say the big banks are safe, While they are too big to fail, that doesn't mean you won't suffer. Post-2008 reforms created bail-in mechanisms where your deposits can be legally converted into bank equity to save the institution. You essentially become a shareholder in a failing bank against your will. The final objection is that banks are better regulated now. Silicon Valley Bank passed its stress tests right before it failed. Regulation creates a false sense of security. It doesn't account for the fact that technology has made deposits infinitely mobile. The stress tests don't model a scenario where half the world tries to move their money via a phone app on a Sunday afternoon. You need to act now while we are still in stage 3. The first principle is diversification. Do not keep all your liquid cash in one institution. You should ideally split your cash into thirds. Put 1/3 in a major, too-big-to-fail bank, not because they are perfect, but because they are the last to go. Put another third into Treasury Direct, buying government securities directly so you remove the bank intermediary entirely. Spread the final third across multiple smaller institutions, ensuring you are always under the FDIC limit. The second principle is to structure your accounts to maximize coverage. If you are married, a joint account doubles your coverage to $500,000. If you have a business, keep those accounts separate from your personal ones. The third principle is to actually look at your bank's risk profile. Most people don't realize their bank's quarterly reports are public. Look at their commercial real estate exposure. If more than 30% of their loans are in CRE, that is a massive red flag. Look at their unrealized losses. If those losses are large, their capital is an illusion. The fourth and perhaps most important principle is to have liquidity outside the banking system. Whether it is a Treasury Direct account or a money market fund that holds only short-term T-bills, you need 3 to 6 months of expenses in a form that doesn't depend on a bank being open. This ensures that if stage 4 hits and the system freezes, you aren't the one panicking. Finally, you must monitor the signals. Set up alerts for bank merger or FDIC seizure. Watch the KBW Regional Banking Index. If it underperforms significantly, the market is telling you that a bank run is already happening in the background. If you see the Fed announcing new emergency lending facilities, that is the ultimate confirmation that the regulators are panicking. Understanding this pattern is the difference between being a victim of a crisis and surviving it. The transition from stage 3 to stage 4 happens in a heartbeat. One headline, one viral tweet, or one more bank failure can trigger the mass movement of funds that shuts down the system. Defensive positioning costs you almost nothing, but being unprepared when the silent run turns into a loud one could cost you everything. If you enjoyed the video, like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.